I'm curious as we kick this off. Well, actually, I'll give you an introduction. How's that, Dean?
Sounds good.
This is Dean, the CEO of Col Wealth. They're basically revolutionizing the index space.
Yeah.
And there's a few interesting ideas around there. And we had coffee probably a year ago before the COVID world.
Pre the second COVID, I think, maybe.
Was it? Yeah. It's over there.
But that is a long time ago. Like, you know how quickly we are already in February, right? And
what's happening?
Yeah.
But why? Like, we always set up every podcast with the story of where you've come from, why you're here, why you're CEO of Col Wealth. So where did it all start there?
Yeah, so I've had background in financial services. Out of uni, I had a job in the energy sector and then started working actually at NZX, the stock exchange. Is it like Wall Street where they're like yelling out? I think when we've had people come into the stock exchange, it's the most underwhelming experience anybody's ever had, because I think what we don't have in New Zealand is like the pit that they have over in the US. So we just have a full electronic market, and so within the actual exchange itself, there's no brokers or nobody like that. Yeah. Actually, the majority of the workforce within NZX are IT people. So it's basically like walking into an accounting or a technology firm. It's dead silent with 100 people sitting in the dark doing their thing.
Do they at least have two phones, or they don't even do that?
No, it's two or three screens.
Do they look stressed?
That's pretty much it. I think they would have looked stressed recently. There's obviously been a few issues with NZX, but no, like I think it is very different to what people expect. So I worked there for 6-ish years, and NZX has a number of different divisions within the general exchange piece, and so I actually started an energy team. So what most people won't know is NZX runs kind of the wholesale electricity market in New Zealand, calculating all the wholesale prices and everything like that. And I started in that and then went into what a big part of an exchange's business is, which is data licensing. So a large portion of any exchange's revenues in today's world is selling data, selling all the information, and that's selling it to 3 News, to display the information on the news every night, through to selling it to the big institutions. And then from there, we actually had an exchange-traded funds business that I got involved in. At the time, there was kind of 4 of us in that. It was a business that really hadn't had much investment for a number of years. We acquired another fund manager, grew that quite significantly, and I ended up moving to Auckland as part of that. So I was in Wellington for a number of years, moved to Auckland, and through that process got to really understand and learn the nuances of building index funds. And in 2018, I thought, well, done my dash there now in this corporate space. Felt like there were things I wanted to do that were of my own. Went out and did a bit of consulting, contracting work. Yeah. And then kickstarted Col, and that was really, as I guess with a lot of ventures as they started, is, you have some experience or some insight and go, well, if I was doing this from scratch today, actually, how would you build it? Rather than kind of it's been built through the corporate to suit kind of the corporate interests, how would you design something that was optimal for the New Zealand customer when you've got no constraints? You're not constrained by legacy technology or corporate processes. You can build it from scratch, from the ground up, and so that's what we did.
Give us a gossip about that corporate. Surely you didn't just leave because, I want to start my own thing. Was there some things that would stop you?
It was a really No, I didn't leave with the actual purpose of going to set something up, actually. I left early 2018. I didn't really even start on the idea till the end of 2018. It was just one of those things I felt like, all right, I didn't see what my next step was that I really wanted to take. I was quite fortunate, I guess, that when I was in Wellington, I had purchased a home, and so I'd moved up to Auckland, and I had sold that place, so I had the ability to kind of step away, and I did one of those things where I just decided I'm just going to step out the door and see what happens. I had no plan. I didn't want to line up another job. I just wanted to see what opportunities came about, what happened when I started to take some time for myself and just really think. I just stepped off the edge of the plank and kind of spent some time figuring everything out and did a bit of contracting work, and
So what happened? So you step off the plank.
Yep.
You got this. How did the idea of Col Wealth start? You met a guy, like over a beer, you're like, we could do this. Like, how did it?
It was really those little moments of going, actually, there's little frustrations that you had. I thought, if we did this or if we built it digitally, we could do so much more, and why don't we have a crack at it? So that was end of 2018, and kind of sat and played with that idea for several months, and then really kind of went full steam in it and committed to doing it, and made that big mental commitment to actually, I'm going to do this. And I guess it's probably really unique compared to starting any other business, because we are a licensed fund manager. We are running a range of index funds, but that is, I guess, unlike starting a lot of businesses, there is a very big regulatory hurdle. You have to go through quite a rigorous licensing process, and that includes things like having quite a significant amount of capital behind the business to make sure that, you're going to be around for a while.
Did you fundraise?
So we had to raise money. So it makes it quite an interesting business to start, because at the time it was myself and an idea, and it's not like I can just whack a website up, see if we get some hits, and then if it starts to build momentum, we'll go from there. We had to go all in. You had to kind of go and get capital and get staff and basically build the whole business before you even start. You have to have everything kind of in place. And that was just under a year, that whole process, and 9 months of that in itself was the licensing process and going through the regulatory scrutiny. And then we were able to go live. And so, it's a very, very different experience. And so you have to have a lot of commitment to it and be really confident actually, you're building something that's going to have value and going to resonate. And there are also a lot of third parties involved. There are like what we have as our fund administration, and we have to have a supervisor and all these other third parties that you have to bring together. And so you have to find these parties that you want to work with that are adding value and getting them equally committed to the vision and what you're trying to achieve and the interests of your customers. So
that's an art. Have you had challenges?
Look, it was, I guess in the scheme of things, it's been surprisingly efficient. What I was very fortunate was we had a great team, and probably that comes down to any business's successes. We were able to get a couple of good people alongside me from day one who really made a difference. And
give them a shout out.
Yeah, well, that was things like, Stephen, our COO, he used to work with me at a previous firm, and so he came across and joined me, and really big commitment. He had young family, a couple of young children, leaving a corporate job, again, so, big commitment on his behalf. And then Kat, who I'd met through the industry. So I had a few people that came on board who I really knew their skills and experience. They weren't unknown people to me, and they really bought into what we're about, and equally as passionate about what we were trying to do for the financial services space. So
what is that vision that everyone's buying into?
So I guess really we're trying to, as much as everybody says it, we are developing a product offering that's very much driven by the interests of our customers. So we work with financial advisors and direct retail, but we're trying to build a product set and a service that's really putting their interests first. So we have fee arrangements that are aligned to their long-term thinking. We're building a product that's designed to good long-term customer outcomes. We're not incentivizing ourselves at all with anything that may be against what we know is good financial behavior and investment practices. So we're not encouraging trading or anything like that. We're really trying to help people and advisors build good long-term products. And so that's been ingrained from everything we do. We really care about every bit of detail. We have also done this as, I guess, trying to be at the forefront of innovation. So the whole business is entirely digital. So when we started from the ground up, we've built every single process of this business in the cloud, so we can actually run it from wherever via our phones. That has a couple of benefits. It means we can keep innovating and keep doing new things. It also probably develops, I guess, a business that's more cost effective. Again, best interest of our customers, stripping out these legacy processes, making it easier for them to engage with their money, making it easier for people to grow their wealth, more affordable, more accessible, all of those benefits that come from being a digital first business.
Do you build it, or did you incorporate different things?
So some of it we started with, we've incorporated third party digital solutions, and then everything else we've built in-house. So, running of the funds, running of index funds is actually quite complex. But we built the entire process and the whole models. And what we think is actually what we know is we've been able to take those learnings from our previous experience and take it to another level. And so I think, having that full control and building it ourselves has meant that we've been able to do the things that others haven't, and trying to be one step ahead and looking to the future with what we're doing.
Who's the guru? Who's smashing away on the computer? Is it you and your mate at the start?
Stephen is very much the guru that's built the investment processes. And so we talk about basis points. So, those are fractions of 1%. Yeah. And we are very interested in every little fraction of 1% that we can find for our customers, to lower their costs and give them better returns. And that comes down to quite sophisticated models that were built to try and make that happen and keep flushing those out, I guess. And,
So would that be the main difference between the larger corporates, like with the legacy products, is inefficiencies, cost problems? Like, what are the main cost inefficiencies or drags in the other institutions?
Yeah, I guess tax is a big one.
Yeah.
So tax is a big issue, and it's one of those things that nobody likes talking about. And we know that most people that we deal with don't want to talk about it. But again, I think thinking about our customer is what would have been a lot easier for us from day one. We run some international funds, and a really easy solution would be actually, rather than us run an international index fund where we have to go and buy hundreds of companies around the world to match the index, we could just buy an offshore fund and wrap it up and put our label on it and call it ours. That has some big tax leakage issues, some extra costs, really easy to do, really quick, and probably the same outcome for the corporate, but we just thought that wasn't good for our customers, and while they don't know or see on the paper somewhere you're losing 0.5% in tax, we know that that's meaningful and, that our customers shouldn't be paying that. So we had to set up a model where we could go and physically trade all of these global markets to replicate an index, and that's saved a lot of costs. And so what investors will see is more in their pocket at the end of the day. They won't see that as a number difference between the two products. And then what's really nuanced about the products we run is we run index funds. So an index fund, basically, we buy and hold companies to match companies that are in an index. As a fund manager, we don't care what those companies are. We are just looking to match the index. And so as an investor, what you would normally expect from an index fund is the return of the index less the management fee. So if the management fee is 0.5%, say, you would expect if the index has gone up 10%, you as an investor at the end of the year should have got 9.5%. That's kind of vanilla. There are actually things you can control to make that better. So rather than 9.5%, maybe you could get 9.8%. And that comes down to expertise and operating model. And we were able to do that last year. And so actually for several of our funds, investors actually got the index return after fees. So the index return 10% as an investor, even after all your fees, taxes, trading costs, you still got 10%. And so those are the sort of efficiencies we're really focused on, and very nuanced, quite technical, but important to us about what we stand for and doing the right thing for investors.
Oh, makes sense. Or it's a great pitch, either or.
Yeah.
No, but it makes sense to me. You also, I don't know if you feel comfortable about talking about the different actual fund managers out there and the drags that they may have.
Yep.
Okay, well, there was one you mentioned was Simplicity.
Yep.
And how that is an index fund, but not quite. Yeah,
so a lot of the focus driven a lot by the regulator here, FMA, has been talking about look at fees. Fees is the one thing that you as an investor can control, right? Don't pay more than you need to. The problem with fees is that it tends to be focused on the very simple thing. Like there's a lot more, my point around tax and things.
Yeah.
These are other costs. You don't see that written down, unfortunately. So it's really hard for a normal investor, without speaking to an advisor, to understand what those other costs are. An advisor who's spent years in the industry is going to understand and say, well, you're going to pay not only this management fee, but you're paying this amount in tax, or there's these other hidden costs that you need to be aware of. So unfortunately, we've got this very focus on fees. And while fees are important, people do need to look at these other costs. And so other managers like that are saying the headline fee is this, but actually not getting anywhere near the index return. And that's tax. That's a drag in terms of comparative to the index. And those are the things we look to try and address. So, because they are costs.
Yeah. What Would you like to elaborate more on the hidden costs? Because a lot of people listening may not have an advisor. So what would be the hidden costs that we talk about, like the names they're called or how they are? Or what they
so any fund manager, so if you go and look, so there are several index managers in New Zealand, AMP, SmartShares, Simplicity, and Kernel, and we would say we're the best, of course. But so the costs really, a really simple way to look at it is what is your net return? What is the net return of the fund versus the index? So if you're looking at an index fund, the index fund may have returned 10%. What was the actual return after fees? But look at it before tax first. So go after fees, before tax. Now, all fund managers have to publish this. So on their website or in their quarterly fund updates or in their fact sheet, somewhere on their website is this information. And you can go and look at just two figures, and that's going to give you a true sense of the cost. So the index return less the fund return. And that is your kind of headline cost. And that will be different to the management fee. The management fee is a number written in a bit of paper somewhere. But actually there may be other costs, there may be transactional costs or other things that they're just not performing that well that mean that the index less the actual investor returns is different. And so those two numbers that you can find somewhere on the fund manager's website is really the key starting point. Tax is quite a complex one to look into, but we do have a blog on that and a calculator to help people. But I would say as a starting point, look at the index return less the after fees, and that's your real cost, not the management fee that's in the PDS.
So, I mean, last time we spoke, you spoke a lot of sense, and you continue to speak a lot of sense, and you're growing, so you're doing things well. I'd be curious as well from the human aspect, because we sort of advocate for the 60-40% or 60% growth asset shares and property and 40% income assets, cash and fixed income. And there's pros and cons of either. What do you think the index fund, what might be cons or that people should be aware of? You know, because transparency is good, and I'll change the camera at the same time. What would be, do you think, cons of index funds and then also the pros?
Yep.
So just roll with it, brother. I'll just... Yes, keep going.
Okay. Who should I be talking to? You now?
In fairness to Dean here, I just changed the camera over and didn't explain what he should do. So that awkward pause was him just looking at me like, what am I meant to be doing? Yeah. Well, what are the pros and cons of index funds?
So the big thing about index funds is obviously transparent and really accessible. So they have democratized investing. So you can start investing in index funds with as little as $1. You don't have the more traditional hurdles that you may have had to get into other fund investment schemes. Mm-hmm. The other big thing, obviously, that you know exactly what you're investing in at any point in time. You know, it's not hidden or it's not an active secret. Is you can see all of the companies that you're invested in each fund, and so you've got a good real understanding of your investment. Now, the big growth in index funds, particularly over the past decade or two, has really been the underperformance of active fund managers has driven a shift from active funds into index funds. Now, a lot of the research out there shows that index funds over the long term are very hard to beat. Active fund managers may have a good year, but it's also really hard to be the number one year after year after year. Mm-hmm. And so with an index fund, you kind of have some certainty about what your future is going to look like. You know, you're going to get the market over the next 10 years, less the management fee. And one of the big benefits is obviously that the fees are typically a lot lower because as an index manager, we're data driven. You know, we're not analyzing stocks. We're not hiring a bunch of expensive research analysts who are trawling through companies day in, day out. We're literally data driven and all about creating efficiency. So the management fees of the funds are typically a lot lower. I guess the downside to that though is, you know, people will say, well, if the market falls, you know, we're not making decisions to avoid that. You know, when COVID happened, right? When it's not like as a fund manager, we decided actually we're going to sell the companies and we're just going to sit on some cash for now. We can't do that. We've got to match the index as perfectly as possible. So that's one of the big common talking points that people will critique index funds on. And same with the view on, well, surely, you know, this is a really bad company. You know, why would you not sell it out? Well, we can't sell it out. It's still in the index. Eventually it'll perform poorly enough that it'll drop out at the bottom of the index. But yeah, that's kind of the whole key with index investing. Again, coming back to the pro though, we would say that over the long term, it's very hard to time the market and it's very hard to pick winning stocks. And just statistically, a good example of that, people think, you know, what percentage of stocks perform above average and below average? You know, it's not half are beating the market and half are underperforming. actually 75% of all stocks in New Zealand have, over the last 15 years, have underperformed the market. So you don't have like a 50-50 shot of picking a good stock. You actually have a 75% chance that the stock you've chosen is going to perform below what the market has done. And so those are the little challenges that come with stock picking.
There's something you talked about as well, was around using index funds for shares investing and using funds for fixed income investing. And obviously you have feelings about fixed income currently, so share that as well. But why do you think index funds make a lot of sense for shares, but maybe for...
Yeah. So coming back to that whole point on exactly what I just talked about, that whole 75% of stocks underperform the market, all right, the average. And so the statistical structure of equities, where you have, say, 5% of equities that really smash the lights out, and then a number that could go bust, and actually quite a large percentage go negative or completely obliterate, basically. That structure means that indexing really works because the average is greater than the median. By that I mean, 75% of stocks perform below average. So the average return of NZ equities over the last 15 years, the end of 2019, was about 250%. The median was about 65%. By median, we mean half of all the stocks were below, half above. So that median figure is about 60%. So when you have that structure, it means that indexing in only a broad part of the market is beneficial. The flip side occurs with fixed income, where it's completely the other way around, where 95% of bonds will be fine. You can hold them to maturity and you're going to get your money back. So it's only 5% or so that will, blow up and you won't get your return. And so that means the reverse is true. The median is higher than the average. And so statistically it makes picking of bonds more beneficial than just owning a broad index. And so that's the statistical structure. Now, when it comes to, you mentioned 60-40. 60-40 is kind of the go-to for investment management for the past 40 years, and it's worked really well. So for 40 years, 60-40 has been an exceptionally strong investment strategy. I think you've got typically you've been able to achieve 90% of the equity market return with a lot less volatility. And so you've had this really great ride. And a big driver of that has been that for 40 years, interest rates have fallen. And so when interest rates have fallen, the value part, the 40% that's in fixed income, has performed relatively well while still also providing sort of a dampener on the ups and downs that you get from just being in equities. Literally in the last 6 months, the world has changed. And it's unknown for a lot of people. And that is now we're at kind of the bottom of where interest rates are going to go to. So, there is now increasing talk that interest rates will rise. And you have to rethink what that means for a portfolio. And it makes it very, very hard to be a fixed income bond manager at the moment. The world is really challenging. For a lot of them, they've never experienced otherwise. It's been 40 years. Basically an entire generation of fixed income managers only knows one thing, and that whole universe has just changed on them. So it's very, very challenging now. Same when we go and speak to advisors. We've been to a number of conferences and say, well, what changes with the 60-40? What do I do next? And do I need to rethink that? Is there things that I need to consider now? And we've seen all sorts of arguments on it. When I've been there, I've been talking about, well, maybe 60-40 investors need to think about going to 80-20, having more equities now because fixed income isn't going to give you the return. Some other managers have talked about, no, keep 60-40, but with your equities, you need to go super aggressive, high growth, emerging Asian stocks type thing, to try and get the total return that you expect from your portfolio. So we're in a really unknown universe right now for the first time for a lot of people. Yeah,
well, to explain the concept of what you're saying about the bonds, so obviously you get the return. We have an agreement. You pay me 2% every year. And then I want to sell the agreement to someone else, but everyone else is getting 3% now. So no one wants my 2%.
Yeah, exactly.
Just to explain.
No, exactly. And that's it. So what you've had from a bond over time is you buy a bond, it's had a really good interest rate. Interest rates have traditionally fallen, and what that's meant is the value of the bonds that you already own that has a higher payout on it becomes more valuable to somebody else because, they go shopping tomorrow and they can't get the rates that you've already got, so they'll pay you a premium. Now, the reverse is true now when interest rates rise, that you've got really low interest rates, and now you're stuck with a bond that's really low interest rate, and I can go out there and buy directly a bond that's got a higher interest rate now. Why would I pay you anything, or what the face value is? Well, I'll pay you at a discount. That's the trouble.
It is. It's going to be an interesting time. It's always an evolving story.
It's really interesting as well, generally, even ignoring the 60-40 piece. I think just where interest rates are now, it's fundamentally changed the whole landscape for anybody who's particularly close to or in retirement.
Yeah.
Younger generations, it's not a bigger deal. It's those that are close to retirement or in retirement who need income, who don't get enough off their superannuation. It's really challenging because it was only a few years ago they would have just had a lot of money sitting in term deposits or, a pretty conservative portfolio, and they would have had a nice little income stream every month or quarter, and that was enough to, sustain a nice lifestyle.
Yeah. Well, they even this is a really good time in the sense if you're an advisor, if you target a person at a certain point in life, because you think, obviously, one, term deposits has historically been how they generate their income. The other thing is house prices have gone nuts.
Yeah.
So think about someone that's going from their home to a retirement village.
Yeah.
And they're going to have that extra capital, and they also don't know how to generate the income. So, and then,
there's a big need for advice because we are seeing a lot of things happening at once here. They're typically older generation who own a lot of investment properties, 1, 2, 3 each type thing. Changing regulations there, so some of them are wanting to sell that down, not only for the regulations, but some are also at retirement now, so they may have a couple of investment properties. They've worked hard for 40 years to kind of get to that position. They sell one now, and now it's a whole new world to them. They've never been an investor in shares or anything like that before. They were thinking, I'm going to sell that, and I'm just going to live off some income off it and, draw down on that, and that will sustain me through. But, obviously now you can't just go and put it in the bank, and so people out there are going to really struggle and need a lot of access to advice and some help with thinking about how do I make sure I don't run out of money, because another really interesting thing I find that people probably forget is about 25% of us live into our 90s. So there's a very big chance that actually you're going to live for 30 years in your retirement. That's a long time to try and sustain, and all of a sudden you need a hip replacement or you need some changes to the house or you need some extra health care and things like that. And it's a lot of work, a lot of planning.
Well, I think in 2017 there was a survey, and I think 60 to 70% of people over the age of 65 had an extra $100 a week on top of the pension.
Really, is that it?
Yeah. It's a huge problem, and there's not enough people to help. That's why we're trying to create these sort of experiences where people...
Yeah, we look at the numbers, like I think is at the moment roughly $180, $190 billion in term deposits, and about 60-70 billion is in on-call bank accounts.
Just New Zealand?
In New Zealand. So we're talking $270 billion of money that is sitting out there at the moment, mostly earning less than 1% before tax. And that's a challenge. That's a big challenge. And, interestingly, that feeds into this whole investment phenomenon around the world as to why markets have risen so quickly post-COVID, right? Is partly because, yes, things have probably done better than people have expected in terms of companies for a lot of sectors. There are some sectors clearly been hit really hard. But it's also the fact that money is coming out of term deposits and has to go somewhere. It needs another home. And so that just is going to something that's going to earn them more than the bank, and there's not many options at the moment, and so property and shares have been a benefactor of these falling interest rates.
Which is scary when there's a correction. You think, so speaking of other homes, what's your thoughts on crypto? Speak freely. It's a safe space. I see all these thoughts swirling around.
Yeah, how do I... Look, I don't understand it at all.
Okay.
I just do not understand it. And I guess what I keep telling myself is that doesn't mean it's right or wrong. And I will keep listening and watching, but it's not something I understand. So therefore, as I think a lot of advisors will talk about, don't invest in something you don't understand. And there are a couple of reasons I don't understand it. There's two arguments for crypto or what it's being used for. That is a store of value or a future currency. It's a digital currency. The digital currency thing, I think we can rule out. I just don't see it being used. There are a number of limitations that you read about, from just the transactional speed, just even getting to the scale that it needs to become a globally distributed currency, that, the amount of energy and processing power for that. And of course the volatility. So it just moves too much for it to be a currency. You can't, I can't go down to the cafe and try and pay with Bitcoin and then find out it's fallen 10% today. So actually I can't afford that, or it's gone up 10, 20%. That makes it impractical from a day-to-day point of view. And I don't think many people that talk about it, while they've had this grandeur and idea of it becoming this kind of digital currency, also to add to that, I have real issues. I don't think the government would let it become a mainstream currency, just on the basis that the whole idea of it is the anonymity. And how does the taxation environment work when we have anonymity? Like, how do you tax people's wages or payments to other people and gifting and all these taxes that sustain our whole society, that fund, infrastructure and hospitals? How do we tax that if we go to this world where people are transacting huge amount of volumes, where there is no ability for anybody to have proper insight to what the tax liability should be on that? So I think that's also an issue there. Flipping over to the second piece, which is where people are talking about, which I think is what most people are investing for, even if they think they're investing for currency, is the store of value. The idea that it's a store of value, it's an alternative to gold, and ultimately anything can be a store of value as long as we all agree that it's got value. I guess I just look at that and go, I think there's a lot of people buying into it at the moment, and they're just going to hold it. They're not going to sell it, so clearly it's not going to be a currency. It's a store of value. Will it keep going up? Is it a store of value, and is that what a store of value is about? The real simple question to me is, how come then if people talk about Bitcoin, do several hundred other cryptocurrencies, because they talk about this limited supply, right? There's only, I don't know, whatever it is, 22 million Bitcoins in the world. How come all these other cryptocurrencies also go up exponentially in value over the last 6 months? Because to me that would mean, well, if we can all agree Bitcoin is a store of value, then Ethereum and all these other coins, so then is there a limited supply? Because we've just got hundreds of different coins that could ultimately just be a store of value. So there's no really limited supply here, because we can just make it or opt for another one. And so I struggle with that conceptually, just to get my head around. And then there are the real practical ones, like, the amount of people who have lost their passwords. I think the record one the other day, $200 million. This guy's lost his 12-word password that you need to get into it, and lost in the bottom of a dumpster somewhere worth $200 million. And, that's just practical, real issues. And there are a lot of people out there who have lost their tokens. I listened to the Hamish and Andy podcast. Yeah. And they bought some Bitcoin a couple of years ago, and they've lost the token and no way to get into it. And so now, I think there's 8 Bitcoins in there, and it's lost. And so, these are just genuine, like, if you're like me day to day, you forget your password, right? If you lose this password, there's no reset. That's the problem. Too much pressure. Yeah, that's a lot of pressure. What are your thoughts on cryptocurrency, I guess?
Well, I always look at it from an emotional standpoint and a practical sense. So it's like, okay, maybe it can go up and down by 300%. Yeah. Can people handle that? My experience is people can't even handle 30%. Yeah. So they're going to be emotionally driven, freak out. And the second thing is the inflexibility of it. So if it's a means of utilizing that to achieve the outcomes you want in life, how are you going to take that out for the unexpected expense, like the hip that you talked about? Yeah. So I think throughout my future career and throughout Greg's prior career, there's always something like this has existed. Yeah. A speculative bet that you could make lots of money, you could lose it all.
Yeah. And I think as much as, another good example is GameStop.
I was going to ask you. Right,
to me, I feel there's a lot of similarities. Bitcoin started going up crazy at the start of the year, then it died away. People got distracted by GameStop, then it came back to it. And kind of you see how much this moves just on people's very short social media-driven interest levels. And, people talked about the idea of GameStop. I think they tried to spin it as, this was retail investors becoming anarchists and taking down the man of Wall Street. And sure, maybe there are some that did that. I still think fundamentally most people who've gone into this speculative bet, and the same I think with crypto, is purely emotional and financial driven. It is the fear of missing out. It is the want to double my money. And I read a really good article out of the US. There's been talks about people who have unfortunately committed suicide and things like that where they've been trading. And I remember reading about one who he wrote it and basically saying, look, he nearly got to that level. He was a 27-year-old teacher who'd worked hard, saved 70 grand, was doing all the good things, investing in some low-cost funds, and his retirement projections were, I'm going to have $1 million in retirement, just contributing, doing the right thing. Got hooked on and thought, I'm just going to chuck a few $100s in. Was reading Reddit, reading social media, and if I lose it, I lose it. And that's probably how most of us would start, or most of us would think of this. I'm just going to have a little flutter on this. I'm just going to chuck some money at it. Emotions took over. It's very hard. And he felt frustrated looking at all these other people on social media talking about, I made 40 grand, I'm up 50 grand, I've doubled my money. And so put more and more in, and then lost his entire savings in 5 days. And I think, we all go in with these intentions of probably thinking I've got, these great emotions, great control over my emotions. But when you start reading what other people are doing, this fear of missing out, it's really powerful, and people do need to be very cautious because the emotional elements and the social media power is far greater than we probably give credit to. And it's very easy to get pulled into this, and all of a sudden you find yourself in a very difficult situation.
Massively. I mean, it's a scary thing. Like there's a study they did with a red light that flashes randomly. Yeah. And people started working out a pattern, but it was a random light.
Oh, really?
So humans have a propensity to find patterns in the random. It gives us security.
Yeah.
So one, you've got that. So one, okay, this seems like a pattern. I recognize, I've worked it out. And then you've got the incremental benefits that you get. So you put in 100, turns to 200, put in 300. Yeah. I only put in money I can afford to lose, and suddenly you put in everything. Yeah. It's scary, and I get a lot of heat, so I'm quite publicly against certain things. So I just want people... Like, one question is, why do you want to be rich? Yeah. Why do you not just want to do what you want to do? Like, do you want a big number? So I'm quite public. My other fear is Sharesies and Hatch. I'm really impressed with their product and their marketing. But in terms of how people are using them, like, there's new kids accounts, man. Yeah. No fees. Okay, go play around with your direct investments. Just ruin a whole generation of investors. And
I think this is probably a shared fear on what does this mean for everybody going forward? And I guess it's a really interesting time because we've never had such ease of access for the masses coupled with social media. These are two exceptionally powerful forces. We've never had them together. Like, even in the GFC, lots of people wanted to buy stocks post the GFC. But remember, the iPhone didn't exist then. It only just came out. We didn't have kind of online trading accounts. People had to call out a broker. There was a process. There was things like, just even the little things, like when you normally buy a share, it takes a couple of days for the cash to actually settle back into your account to be able to trade again. Now that's instantaneous. You can, again, everything's become this instant hit, this endorphin rush that we're after. And so this is scary to see, well, what happens and how does it end? Do people just keep trading until eventually they keep chasing bigger and bigger returns? And I put to some people, I think people's expectations now as well. There's a lot of new investors who have high expectations that they can go, it's going to be really easy for them to go and make 50%, 100% every year. Because a lot of them have. But put that in context. Our smaller mid-cap fund is up 96% since 23rd of March. So the market has gone up. That's been exceptionally good timing to become a new investor. But confusing that with great wisdom and you're a great stock picking guru, and then also thinking that's going to continue is dangerous, because it doesn't take much to figure it out. I put to somebody and go, if you think you're going to make 100% every year, just calculate that out. What's 10%, 10 grand times 100% year on year for like 10 years or 20 years. All of a sudden, 20 years from now, you're the richest person in the world. And I just don't fundamentally believe that in 10, 20 years' time that you're just going to trade your way to becoming the richest person ever in the world. And that's the reality is people, 100% that's easy. Yep, maybe once or twice, but that doesn't keep going on forever. And so, yeah.
I'm glad we agree on that. Final words in terms of one, how they can find you.
Yeah.
And then also like if you want people to remember this episode on, or like a concept that you want people to.
Yeah, I think generally for a lot of people, like I think investing is going to be key to, as you and I probably talked about a lot, is we want to see people secure their financial future, right? But it's doing it in a way that's proven over decades, that is long-term focused, removing of the emotion, and focusing on things you can control. And go out there and enjoy your life. Don't get sucked into the rabbit hole of spending hours on Reddit and social media and thinking about trading. Go and live your life. And you can achieve that financial freedom by doing these good, simple behavioral things. So, that's what we really care about. And we want to help people do that in any form and through whatever means, and with an advisor direct or through property, whatever it may be, as long as they're thinking about this good behavioral stuff. So, they can find us colwealth.co.nz. We publish a number of blogs where we share a lot of these thoughts. So encourage people to just take some time to read and think about what they're doing and how they're going to get there.
Cool. Well, thanks, Dave.
Thanks, Ryan.
Cheers, guys.